All right. Welcome, welcome. Everybody's slowly coming in here. All right. As people are rolling in, please feel free to put in the chat where you're coming from today, just so I get a better sense of who's here with us today. We'll just get going in a few minutes here, just wanting people to roll in. But feel free to put in the chat where you're coming from. Give it one more minute. Chat is disabled. Okay. Well, if chat is disabled, looks like we can at least use the, what is this? Question and answers? All right, well, we'll get that fixed. Sorry, I didn't realize chat was disabled here. All right. Well, we can go ahead and get going here, unless we got Ontario. Ava, real quick, are you able to check to see how to disable the disabled chat?
We're working on it.
Sounds good. All right. Cool. Well, let's get the ball rolling. I appreciate everybody coming in tonight. Welcome everybody.
All right, let's get everybody to write in the Q&A instead of chat, because chat's disabled, so we'll do the Q&A.
Okay, thanks, Ava. Yeah, so we'll put put your questions in the Q&A. Also, where you're coming in from. We got Ontario already here. Perfect. All right. And just to confirm, Ava, you could still see my presentation on the screen here.
Yeah, it looks great.
Okay, great. All right. Well, welcome everybody, and thank you for joining today's market outlook for 2025. So I'll be focusing on where the data is pointing for multifamily and build-to-rent SFR assets, and more importantly, where the best opportunities are beginning to reemerge. Most of the data that I'm going to be presenting tonight is real-time, hot off the press information that has just been released, and what I'm calling the start of basically a rebound cycle. We'll show you why the conditions are aligning for smart capital to move into assets now. All right, next slide here. There we go. So why multifamily and build to rent, and why now? So I'm going to cover this in a lot more detail later on in the presentation. But to summarize, what we're seeing right now is a tale of two markets. We've got short-term uncertainty, yes, but long-term fundamentals that are incredibly supportive. As mortgage rates in the United States have pushed up to about 7%, we've seen home ownership affordability plummet. That's driven more demand back into rentals, especially for Class A and suburban product. This affordability gap isn't just a blip. Projections are showing that it's going to be persistent, reinforcing the need for quality rental housing in the long term. So 2024 was a major inflection point, the highest absorption on record in the United States. And 2025 is already shaping up to be stronger than that. Importantly, absorption is now outpacing deliveries, something we haven't seen since the pre-2011 cycle. that's a critical signal for improving rent pressures and reduced concessions. Occupancy is currently at 95%, which puts us back into an equilibrium. And this is the base from which growth reaccelerates, creating a stable floor. So this is the inflection point, a prime buying opportunity where cap rates have adjusted upward, pricing is stabilized, and investor sentiment is now beginning to thaw. So there's, investors are sitting on record amounts of capital ready to be deployed. And we're hearing from brokers, lenders, and different equity groups alike that the best opportunities to buy is right now for the next 12 to 18 months. And once rates ease and sentiment returns, we're off to the races and it's going to be more competitive. So at CPI Capital, we view 2025 as a vintage year, one of those rare times where price and timing and the fundamentals all align. So who am I? My name is Paul Hopkins, and I come from the construction and engineering world, managing billion-dollar infrastructure projects that have taught me to plan, de-risk, and execute projects under pressure. And since 2015, I've been focused on multifamily syndications, raising capital, underwriting deals, and driving results for our investors. I've completed 6 full-cycle deals over 100+ units, and 2025 is actually shaping up to be one of the best entry points that I've seen. We recently closed also on a build-to-rent development project in San Antonio, and groundbreaking is scheduled later for August of this year. We recently, went through the capital raising efforts and fully subscribed, but we actually do have a few spots left. And if you're interested in knowing more about this deal, we'll put the link to the landing page in the chat. All right, so I want to start off with a recent survey that was conducted by the National Multifamily Housing Council, which surveyed multifamily leaders, which reflect what we're seeing on the ground. The market is starting to thaw, and we're finally seeing alignment between buyer expectations and seller flexibility. Deal flow is improving. More importantly, 45% of these surveyed participants say it now is a better time to borrow. We're seeing lenders get more aggressive on the overall leverage, the structure, and the overall spreads. So if you're a sponsor with a track record and you have equity available, the deal is going to get done. So this is the playbook we've been preparing for, where the gap between pessimism and opportunity is coming more into alignment. And now capital is beginning to move again, is what we're noticing. So cap rates haven't yet compressed, but this is the best time for when deals get done before headlines start to say, the market is back. So at CPI Capital, we're not trying to just time the bottom. We're targeting quality assets while others are in hesitation. And that's where outperformance is born. So let's look at the demand. Demand continues to surprise the upside. So in Q1 of 2025 alone, we saw over 147,000 units absorbed across the United States, while just 116,000 units were delivered. This dynamic actually dropped the national vacancy rate to 5%, which is the lowest that we've seen since 2022. Basically below pre-pandemic norms of 5.4%. What makes this even more significant is that we're coming off a 2-year stretch of record construction where 1 million units have been delivered since 2023. That's a significant amount of delivery. And yet absorption is now outpacing that supply. This marks a clear reversal from the softening that we saw in 2023, which is a powerful indicator that demand fundamentals are not only intact, but accelerating. So the good news is this isn't just that the absorption is strong, it's that the apartment delivery wave has peaked and at nearly 600,000 units across the United States, and the forward development pipeline is thinning fast. 557,000 units were absorbed in 2024, with 580,000 apartments or units being absorbed, forecasted for 2025. So what that means for investors is that vacancy compression is likely going to continue, and concessions should start to diminish over the next 12 to 18 months. So if you're in the market with basically durable demand like we are in Tampa and San Antonio, this environment gives your assets a tailwind. So there are three key forces that are fueling this surge in apartment demand across the United States, and none of them are short term. So the first key force is a healthy labor market. So the US added over 228,000 jobs in March, and the unemployment rate remains low at 4.2%, supporting wage growth and household formations. Importantly, this is happening without overheating. So it's a Goldilocks labor market with stable, steady, and supportive of rent growth. So behind all the rent growth and absorption, you need employment and income growth. And we're getting both in this market. The US added nearly 2 million new jobs over the past year, and household formations continue to outpace expectations. The income side is just as important. Incomes are rising faster than rents, which makes today's rent growth sustainable rather than speculative. So there are these kind of fundamentals that support rent increases without eroding the overall occupancy. A very healthy place for operators and investors alike. The second key force is demographic tailwinds. So millennials, making up 73 million of a population, are staying in rental housing longer than any prior generation. Many have delayed home ownership, they've delayed marriage and childbearing in Class A and B apartments well into their 30s and 40s. And meanwhile, the Gen Z generation just entered into their prime rental years. So with 70 million members, they're forming households at scale, and most of them wanting to rent and not buy. So we're seeing a double demand wave, millennials staying longer, Gen Z that is just starting into this rental phase, which creates a durable, expanding renter base that supports occupancy and pricing power into the next decade. What we're seeing now is healthy fundamentals driven with rent growth. It's not overheated spikes like we saw in 2021. Rent growth is happening in step with income growth, which tells us it's affordable, absorbable, and durable. So as construction starts slow, occupancy starts to rise, and we expect this trend to strengthen further into 2026. And the third key force is the affordability gap, or the growing cost of own versus rent. So today, the median home payment for a median home price and median home payment is just over $3,000 a month, while the average apartment rent is just over $1,800 a month. So over the past 5 years, home ownership costs have jumped 91%, while rents have increased only 27%. So with mortgage rates still hovering around 7%, many would-be buyers are staying in rentals longer, prolonging the leasing demand and keeping renewal rates high. So This affordability gap is unlikely to close soon. It's widening every moment, and it's the most durable drivers of demand that we're tracking here at CPI Capital. This slide here is basically an investor's version of job security, which is tenant stability. The national lease renewal rates have climbed to 55%, beating the 10-year average of 53%. This means that more renters are choosing to stay put, which helps operators like us reduce our overall turnover costs, maintaining our occupancy, and boosting the NOI consistently. So that stickiness is being driven by one core theme. Owning a home is still out of reach for many households, making the rental value proposition stronger than ever. So we don't see that changing anytime soon, especially not with home prices elevated and rates still quite high at 7%. But if rates even fall, the supply constraints are real long-term drivers of affordable pressures. So in March of 2025, single-family housing construction starts had dropped 14% month over month, which is driven by higher construction loan rates, rising material costs from tariffs, and tightening of labor markets. So we're now in a position where even a small mortgage rate drop, say it drops by 25 basis points to, or down to even 5.75, this could trigger a demand spike without enough new supply to really absorb it yet. So that imbalance still puts upward pressure on both home prices and apartment rents, especially in the undersupplied markets like we are seeing in the Southwest, in Florida, and in Texas. So long term, the U.S. housing shortage is deepening and not resolving right now, and that creates durable tailwinds for multifamily owners and build-to-rent developers. So this slide tells you of what's coming, or basically what's not coming. And while we're still at 500,000 units delivered in 2025, the number of new starts has fallen 76% from the 2022 peak of 157,000 units down to 38,000 units in Q1 of 2025, hitting a 13-year low, which was 37,000 units back in Q2 of 2011. So the current completion pipeline is still working its way through, but beyond 2025, the drop-off is very steep, especially in primary and secondary metros. So it's the age-old adage of like supply and demand. So demand is increasing, but there's no supply to meet that demand. So this is where it pays to actually know some submarkets. So while the national inventory growth is tapering, we had over 2% inventory growth that's forecasted for the U.S. overall in 2025. But there are markets like Austin and Charlotte and Phoenix, which I've shown here on the slide, that are still digesting larger supply waves. So those metros are forecasting to grow their inventory by 6.6% to 7.2% this year. That may soften short-term rent short-term rent growth, and extend concessions in those markets. But nationally, this chart reinforces the bigger trend. Starts are falling, deliveries are peaking, and by 2026, we'll likely see tighter markets across the board. So even if rates ease up, material costs are adding a new layer of basically the supply friction. So the U.S. may impose or reimpose higher tariffs on Canadian softwood lumber by later this year in fall of 2025. So that move will, significantly increase framing and material costs for developers. This already comes at a time when construction costs are already elevated, and labor is, already tightly constrained, and construction loans are, they remain to be expensive. So even if rates drop, the tariff-driven cost pressures will continue to limit new housing starts, especially in the smaller, thinner margin projects. But for us, we're being bullish on this happening because for existing assets, this is a well-timed event. Even with us also in a build-to-rent development project that we're in right now, we're well planned, well executed, and prepared for a lot of these material costs increase and still provide strong, healthy yields to our investors. But it's showing that we're going to have a strong rent performance on our assets. So let's address one of the few short-term headwinds that is currently happening right now, which is consumer psychology. So the University of Michigan's Consumer Sentiment Index had dropped to 52% in April. And historically, when sentiment drops below 60, household formation starts to slow temporarily. That's because uncertainty causes people, especially young adults, to delay moving out or renewing a lease. But this brief softening that we're seeing in demand as a result, but it's not a lost demand because it's a delayed demand. So as you can see, with the overall fundamentals, job growth, demographics, affordability pressures are still intact. So as sentiment recovers, the postponed household formations will materialize over time, likely boosting absorption. So as you can see, absorption hitting a peak at 147,000 units in Q1 of 2025. So this opportunity moment where cap rates have basically peaked and momentum we're seeing is start to shift. So after rising 120-ish basis points from 2022, the average multifamily cap rates have hit a 6% in late 2004, but now have stabilized and starting to come back down 5.5 to 6% across the nation. According to CBRE, CoStar, and RealPage, for example, we could see cap rates compress slightly in 2025, around say like 17 to 20 basis points, as interest rates start to ease up. And I'll talk about that on some following slides. So this gives investors a window to buy at larger lending spreads before the next round of rate cuts and pricing competition compresses those yields. So as soon as rates start to come back down, it's going to get very competitive in the market. So the story here is about timing. We're likely at or near peak of the cap rates, and that's historically when the best performing vintages are basically seeded. So we're going to touch briefly on the consumer price index because this factors into what's really happening in the market. So inflation is doing exactly what the Fed wants to see, slowing materially on both the headline and core levels. So this creates a space for rate cuts later this year, which could drive cap rate compression and increase investor activity. So, however, the wild card, as we know, is tariffs or other policy changes. So if they remain in place through Q4 of 2025, we could see cost side pressure reemerging from activities like construction. So it's worth noting that the CPI dip that happened in March was driven by volatile and non-sticky categories like energy and airfares. Also, with the tariffs that were introduced, a lot of companies front-loaded their orders so that they could beat these tariffs And that was kind of the volatile incident that happened as well. But overall, what we're seeing reinforces why the Fed is looking more at the core inflation and the wage data when considering their rate cuts for potentially later this year, which means real estate remains in a strong position if inflation stays below their target. So the key takeaway, headline inflation eases, headline inflation easing gives flexibility, but core strength keeps rent growth and real asset demand intact. And finally, this is the dilemma that the Fed is currently facing is, the uncertainty with tariffs and policy. It could reheat pricing, but particularly in goods like, housing and development. But that's why we think rate cuts may happen slower than some of the headlines may suggest. And what makes existing assets that are on fixed rate debt even more valuable. So the bottom line, we're watching for this volatility, but CPI, the Consumer Price Index, trends to still support the constructive view on multifamily and built to rent. And the last slide here on the CPI, the trending good news for real estate investors, especially those in fixed rate or value add debt strategies, like we typically put on our assets. The Fed, what we're understanding, they're not rushing. Obviously, the market has been shocked and tested with these tariffs and some of the recent policy changes, and it's creating hesitations. But it's also we need to overall maintain CPI Capital's thesis. Underwriting conservatively, preparing for any of these volatile markets, securing fixed rate debt, and invest early in the cycle when spreads are wide and cap rates are favorable for us. So the Federal Open Market Committee recently met on March 19th, and they actually have another meeting scheduled for tomorrow. And so what Chairman Powell is basically saying, they're signaling patience to the tariffs and the policy changes that are going on. So the dot plot that you see here on the right shows a steady path projection forecasting potentially up to 2 rate cuts across 2025 and 26. So overall, this reinforces our strategy to underwrite conservatively, assuming rates will ease gradually but not aggressively. And we expect a stable cost environment, stable cost of debt, lending environment, with modest compression on cap rates in the later half of 2025. So another takeaway is that the Fed is basically telling us, don't panic. We're not pivoting, just patience. And they're relying all on data. That's what they're looking at. So that's a signal of economic resilience. There's no weakness, and it's great for long-term investors, and it's a green light for us to stay focused. So it reinforces our belief that now is a time to act accordingly. So if you're underwriting today, like we are, best case is to look at assuming flat interest rates over the next year, with downside optionally if CPI keeps improving. This favors fixed rate debt, looking at cash flowing deals, or value add strategies like we have on our build to rent development project. So our approach at CPI Capital is staying active, but we're staying disciplined with our underwriting deals conservatively, and making sure that there's a very healthy yield with locked in rates. Here's a quick snapshot of where the capital markets are at today. Basically, from what we can gather, there's liquidity is plentiful. There's over $300 billion in private equity dry powder that is waiting on the sidelines, waiting for this opportunity to come. That capital is primed and deployed, primed to be deployed as soon as the market clarity improves, which we're already beginning to see in Q2 of 2025. This is a very strong signal that capital allocators are ready to act, and multifamily is at the top of their target. Not so much office, not so much industrial, but multifamily because of the fundamentals that I expressed or explained earlier. The debt markets are starting to stabilize. So we saw some temporary spikes in the CMBS and GNMA spreads in April, but those have already started to tighten up. And so this is a sign of normalization, improving our lenders' confidence going forward. So there's also options for rate buydowns that are still viable, especially on value-add deals, giving sponsors flexibility to optimize cash flow in the early years. But overall, demand is shifting to rate-adjusted opportunities. So currently, there's still a strong demand for fixed-rate debt with a clear upside potential. So to summarize, we at CPI Capital are very bullish on multifamily and build-to-rent in 2025. Multifamily demand remains resilient with the pipeline significantly dropping off, and absorption has been increasing and outpacing that supply. Millennials and the Gen Z generations are creating huge wave of demand for more rentals. Capital is starting to return. There's a lot of dry powder that's out there waiting for this opportunity, and timing is very critical. And like I said, I feel that we have peaked on our cap rates. It's going to start coming down, and it's an excellent time. So we just closed on our build-to-rent development in San Antonio that we're very excited about. Again, if you want more information on this, so please see the deal link in the chat or in the question Q&A. There we go. All right. So that was a lot of information, but it's important to look at a lot of those fundamentals to see where we're at in the overall market. But now that I've covered basically the overall national trends for the United States, I'm going to zoom into basically the 4 markets where CPI Capital is either currently active or currently pursuing opportunities. These different metros, they check all the boxes for what we're looking at. We got population growth, rent growth, job growth, median household income growth. The development pipeline is dropping and it's a favorable business climate. So we're going to start with looking at a quick comparison table, and then I'm going to walk through why each one is unique and why we're particularly bullish on Tampa and San Antonio right now. So here's a side-by-side comparison of the 4 major markets that we focus on. I know a lot of other groups are focusing on the Sun Belt and Texas markets as well. But this is why we think that timing is especially favorable right now. So in Tampa and St. Pete, Tampa saw a supply spike in 2024, around 14,000 units, which is nearly about 5% of the inventory. But that's already beginning to taper, with 2025 deliveries dropping about 40% to 8,300 units. Occupancy is still holding at basically 94%. Initially, at the beginning of the year, here's an interesting statistic. At the beginning of this year, CoStar and other sources were projecting that occupancy was going to be at 93% in Tampa. We're already at 94%. So it's already climbed back up in Q1. So that's how fast this is moving. And we're currently in that stable condition. Jacksonville, this is a market that's remained resilient, and we're expecting a rebound in rent growth. It did see some softening in rent, because of the deliveries that happened in the last 2 years. But we're expected to see the rent growth happen back in 2025, in the back half of 2025. Supply is limited with just over 3,000 units expected next year. For San Antonio, occupancy is recovering faster than expected as well, now projected to be up to almost 94% by the year end. New supply was elevated in 2022 through 2024, but that wave, like I mentioned, is burning off. So it's making 2025 a very strong entry point into San Antonio. So we're already actively developing here. We're actively looking for more opportunities in this market because we're super excited about San Antonio, the growth, and what's happening there. And I'm going to explain more on a few slides from now. In Dallas-Fort Worth, it's a market that we're just looking at, but Dallas-Fort Worth remains, it's a very stable economy. It remains to have a long-term rent growth, and it's absorbing some of the largest construction pipeline in the entire country of around 37,000 units. So we're carefully looking at this market for overall stabilization, but before we enter in aggressively. But that's soon going to change. So if we focus in on Tampa's rent growth and occupancy gains show us that the 2024 supply wave is being absorbed very efficiently. Rent increased by 1.9% year over year, while occupancy hit basically up to 94.6%, which is 120 basis points year over year. This market is back in equilibrium. Like it had a softening, but it bounced right back. And it's positioned to be a very sweet spot for us in acquisitions before prices start to fully inflate. So we're tracking this market very closely. We're analyzing deals on a constant basis in this market, waiting for more deal volume to come out. So it is an exciting time to be looking at Tampa. So Tampa is also a market that's, it's cleared that supply spike and still maintaining the overall strong occupancy. So with 2025 deliveries nearing 35% lower than it did last year, rent growth is already showing on a rebound and a positive territory. So it's positioned, for a steady rent climb into 2026. So we're tracking all the different submarkets and looking for the new job growth and employment hubs and what is attracting new tenants and households. So the overall job growth and corporate relocations, this is just bolstering that for the long-term rental demand, we need professional job growth as well. So corporate immigration, we have a rising tech startup base that's in Tampa. And you don't see this kind of white-collar expansion and startup formation unless the region has strong economic stickiness. So, companies like Foot Locker had recently relocated their headquarters to St. Pete. It signals long-term confidence in this region. The demand supports both multifamily and built-to-rent products in this growing environment. So Tampa's population growth at a 1.9% household growth rate may not sound like much, but that's 2 to 3 times the national average, honestly. And it represents real persistent rental demand. People are moving to Tampa. It's an attractive place to live, great place to live. You got great weather, you got great jobs, you got great beaches and sports teams alike. This is why occupancy is basically rebounding after a very heavy delivery year. So the population and job growth fundamentals remain in place for Tampa. This sets up Tampa for continued rent growth and tight leasing conditions for the next year. We're already seeing that in our own properties, and the properties that we're underwriting. The rent growth is already happening, and it is an exciting time there. So this is exactly what we like to see. It's a healthy metro that it beat out the supply wave. The momentum is building, and it's not fading. So Tampa remains a core target for us, for the rest of this year and beyond, because it has all the long-term fundamentals and drivers. Now let's turn to San Antonio. So unlike some overbuilt metros, San Antonio is actually their absorption is catching up very fast. And that tells us.
Paul, I think we also have a question about San Antonio, so maybe you can do both right now while you present.
Okay. Yes. So how do you take into account that the real estate market in San Antonio is on a declining trend currently and in the unforeseen future? Well, let me address the slides, and then maybe that will change your opinion on why it's a declining trend. I don't necessarily see that, but let me go through a few slides, and if you need more clarity, feel free to ask in the chat here. So, unlike other overbuilt metros, San Antonio's absorption rate is catching up fast, and that tells us that this market is undersupplied for its current demand levels. So occupancy has increased 100 basis points year over year, and is expected to continue to rise throughout 2025. That's a trend that you want to see as a value-add buyer and a build-to-rent developer. So this rebound, San Antonio did get hit with the oversupply, but it's in a rebound position right now. And you can see on the next following slides why it is. Next slide here. There we go. So the rent growth. The rent growth especially is encouraging after it was a rough patch in 2022 through 2023. But it shows that pricing power is returning, just as CPI Capital prepares to bring on new product in this market. So the 2.6% rent growth forecast is a very healthy forecast, and that's in line also with wage growth, which is a sign that we can grow rents without pushing tenants out. That's a key thing. You want to be able to have that affordability for your tenants. So top performing submarkets spread across the city, geographically diverse opportunity, where build to rent and value add is a key focus within this market. So San Antonio, like I mentioned, has already passed its peak supply wave, which was in 2022, and what we're now seeing is in the correction stage. So as smart investors act on the right side of this cycle, the overall permits and starts are down significantly. Supply is no longer the headwind here. It's now setting a stage for favorable rent environment. And the peak, with being in the rearview mirror, 2025 and 26 are shaping up to be the very sweet spot for stabilized cash flow and future upside. So San Antonio is very diverse when it comes to the overall economic drivers. San Antonio doesn't need explosive tech growth to drive the overall housing demand. It has a very balanced and recession resilient economy. There's not just job tech, there's blue collar, stable work. There's factories that are being built in and around San Antonio. You could see the overall infrastructure improvements. They're putting nearly $2 billion of improvements into the airport. Over $2 billion of infrastructure on it, expanding and widening the highways in and around San Antonio. The state and the local governments actually see the need for that expansion growth. So they're preparing for that right now. So it's a perfect opportunity for our build-to-rent product that we have. And it's a great spot. It's affordable. It's an affordable city where many families are moving to that are seeking overall stability and affordability, which a build-to-rent product is an exact purpose for that type of demand. So it's especially powerful in the markets in the South and the Northwest, where it's underserved by quality rental housing, where BTR strategy aligns, where the jobs are actually growing. So San Antonio is one of the few metros where affordability and job growth still coexist, like I mentioned, making it a fertile ground for long-term renters. So we're not just seeing downtown growth, it's happening throughout the entire city and working class suburbs, right where we're building our BTR. So population growth is happening faster than the supply growth, and in many neighborhoods, supporting the strong lease-up velocity that we're seeing in the deals that we're evaluating. So overall, this investor outlook for San Antonio, it's got steady performance with low volatility. So unlike other boom and bust metros, San Antonio offers reliable upward trending performance. It's a market where investors can expect some consistency rather than chasing volatile upsides. We're expecting overall rebound on net operating income in that market, driven by rising occupancies and rent growth. And San Antonio typically offers cap rates that are higher than Austin and Dallas. Austin and Dallas have been, a real target for many other investors, but San Antonio has kind of been left on its own. But there are more favorable yields in that San Antonio market, ideal for cash flow and equity growth. And it's in its early phase of the next growth cycle. Like I mentioned, it's expanding its airport, it's expanding its highways. It's seeing the overall growth, and it's a very exciting time in San Antonio. So hopefully that answers the question that came up. Okay. There we go. So why build to rent in San Antonio? I think I covered a lot of these points already. San Antonio's population is growing at 2% annually, driven by household formation and in migration. It's affordable, with the high mortgage rates that are currently there. It's pushing families into the rental market, especially those that are priced out of homeownership, where BTR then now fills that void between apartments and like the for sale homes where they can't afford the home. They don't want to live in the apartments, and it's perfect for the build to rent, where renters want maybe some privacy, some extra space and that community without feeling the burden of that ownership. And its location. So we're targeting different markets like the south and northwest of San Antonio, where areas are they have a broad-based demand for accessible land, ideal for build-to-rent developments. And you've got new employment and job hubs and medical campuses that are all reinforcing the localized rental demand in those different corridors. So build-to-rent typically commands like higher rents per square foot than traditional multifamily, but you got stickier tenants, you got longer lease tenants, which has lower turnover and creating more stable cash flow. So, of course, I can't talk about the the economic projections on 2025 without having to talk about the tariffs, which is definitely a wild card policy that's currently in place. But tariffs, like on materials like lumber and steel, are expected to rise construction costs maybe up to 3 to 5%, which can discourage some developers from launching new projects. So this reduction that's happening in the future supply will still create immediate competitive advantages for existing assets and well-timed developments like ours. So it's great news for multifamily because there's fewer starts on the horizon for the existing properties. In where there's supply, or there's demand and there's no supply, that creates an advantage. Build to rent still remains compelling even with tariffs. So we're obviously keeping an eye on this very closely, and making sure that when we evaluate our build to rent development deals, that we're able to, uh, with our buying power, we're able to source a lot of the materials and lock in prices based on the volume that we have, and that's in our favor. And we're also out there shopping for new vendors, new suppliers, and overall domestic domestic supply of the materials. So, the overall takeaway, the reduced pipeline of new units that are coming on, poses more rent growth, even with these tariffs and different policy changes that are currently happening in the United States. So before I conclude, I just wanted to share another recent survey. So I shared the NMHC survey at the beginning, and I'm sharing another survey here that was performed by Berkadia, where they interviewed over 240 private investment companies on their 2025 outlook. So don't just take it from me. This is also coming from very seasoned, experienced other private equity groups, where they feel that now that we're at a 94% national occupancy, what Berkadia basically calls the stabilization point, means that apartments are in demand and it's outpacing the supply for the first time in years. And capital is now starting to come off the sidelines. 83% of investors start planning to expand their portfolios this year, either moderately or aggressively. So the window of limited competition is starting to close. Investors are leaning into growth again, signaling confidence that we're past the worst of that overall correction. Core value and value add properties still dominate the investor strategy, which aligns with our focus at CPI Capital. We're targeting assets with operational upside, below market rents, and reposition potential. And they're also saying rent growth is back, but conservatively, they're underwriting deals where these groups are forecasting 1 to 3% rent growth, with conservative assumptions around the exit cap, typically around 25 to 50 basis points higher than today's. And that's kind of what we do as well. We go that 25 to 50 basis points higher depending on the time horizon. So that tells you that people are buying today with long-term outlook. They're pricing in their risk, but moving forward regardless. Fannie Mae and Freddie Mac. This is also from the survey that was taken, and the participants expect that active lenders like Fannie and Freddie are expected to be the most active lenders in the multifamily space. Most investors are expecting up to about 2 rate cuts through 2025, approximately or roughly 50 basis points, alongside the 10-year Treasury finishing between 3.5 and 4.5. So while we might not return to the super lows that we had a couple of years ago, there is a growing consensus that borrowing costs will become favorable. 71% of respondents see no major cap rate change ahead. That stability supports underwriting. It makes it easier to commit to capital. And overall, with the tariffs, they've seen spreads on bridge debt increase because of tariffs. But that's why we like to focus on fixed rate debt for our deals. And finally, 63% of the investors surveyed believe that renter demand will outpace new apartment supply in 2025. Another strong signal that the market is stabilizing and ready for targeted rent growth. The Sun Belt and Texas areas are basically where the focus is. So like Southeast and Florida and Texas continue to lead the way for the focus for these investment groups. They're focusing on Class A and B assets, that offer the stability, and that bodes well for both traditional multifamily and build-to-rent strategies. And there's a surge that's happening in cross-border capital. So global investors that are starting to take note, particularly like you got on the chart here, you got Canada, Asia Pacific, and the Middle East, which is receiving a lot of international attention coming into that market. It's adding a layer of validation that we're all trying to see locally. So as I conclude here, hitting up on our hour here. So the overall conclusions and investment implications. So across the U.S., especially in high growth Sunbelt metros, the overall multifamily fundamentals are regaining strength into 2025. Occupancies are stabilizing in the mid 90% range, while rent growth is resuming at a healthy, sustainable pace. Although some markets, like Jacksonville and DFW, have been navigating temporary oversupply, the broader outlook for those markets as well are strong. You got demand drivers like job growth, in-migration, high ownership costs remain firmly intact, especially in the markets that we're looking at. So from a timing standpoint, 2025 represents a compelling window for multifamily investors to get into this market. Property values, they're in the reset mode. Interest rates are expected to gradually decline, and buyer competition remains right now manageable. But it's a good alignment for all us, but it may not last long as the competition heats up. So we're actively looking for deals. Our build-to-rent development is perfectly aligned for this opportunity that's happening right now in 2025. And finally, despite the short-term fluctuations, the overall long-term trajectory for multifamily and build-to-rent remains undeniably bullish for us at CPI Capital, especially in the Sunbelt markets where you got strong job growth and population growth and migration trends. So this sector has demonstrated resilience through the pandemic disruptions and the interest rate volatility that we've seen recently, and its overall position to outperform, through 2025 and beyond. So whether it is value-add multifamily in Tampa or build-to-rent communities in San Antonio, we feel that now is the time to capitalize for the next decade. This is the perfect opportunity to get in. While we're seeing rent growth and absorption outpacing the overall supply, and new construction constrained by tariffs and policy, we feel that this is now the time to enter into the market. And with that concludes my overall presentation and opening it up to Q&A. Let's see, Q&A here. Okay, so if BTR is promising, why is the project selling the properties instead of keeping and renting them for cash flow and appreciation? That might be a strategy that we will do in the future. Our partner also has investors that are looking for cash flow assets as well. So we're meeting that demand. He's of 80,000 investors that are looking for single family rental properties to own. And this was a perfect property to basically get into the San Antonio market, get the wheels moving on this project and this development, and sell this off. There might be another strategy when we see a perfect opportunity to develop a larger property where it makes sense. So like say like 100+ plus units that we could start to add in several different amenities and overall have more cost efficiency, that's when that would make sense, to keep it for a long term. On the smaller ones, it's great, but the overall efficiency and costs, we can get that better on larger projects. So hopefully that answers your question on that one. Are there any other questions? No? Okay. Well, perfect. Our contact information is up on the screen here. And you're welcome to reach out to any one of us at CPI Capital. Again, if you're interested in that build to rent development projects that we currently have in San Antonio and taking a look at that, August, do you have the link? Let me see if I could pull up that link real quick.
Not allowing me to post the link. That's why I haven't yet.
Oh, interesting. Okay. I'll put it under here. I put it under one of the answered questions. So you guys could click on that link and follow the link to that. Okay. Well, that being said, I thank everybody for joining us today. And look forward to working with all of you in 2025. Stop. How do I stop?
You stopped the whole thing, I believe.
Yeah.
Stop everything.